And good morning, everyone. Welcome to Breakfast Club, September 22nd. John Hutchinson, Jeff Wood will be along here in just a couple minutes. He had a computer failure at the very last minute. These things happen. First check in the market looks like it'll be slightly down day, maybe a day of digestion following pretty extensive rally last week, as the Fed delivered on a quarter point rate cut, signaled additional cuts coming in the remainder of the year. Let's talk about a few things, not much. I mean, obviously, aside from my own enthusiasm, the general stock market enthusiasm around artificial intelligence continues to rise. That helped to fuel both the NASDAQ and to a degree the Russell 2000. Russell rising last week on the back of the Fed rate cuts, as rate cuts really help small caps and mid caps. But the small cap index had been trailing and lagging the major indices pretty heavily through much of the early part of the year. Looks like that's starting to turn around, and some of the historical data shows that the Russell can tend to outperform the major indices during rate cut cycles. So that's something we'll be investigating for you and keeping an eye on. Expectations for two more rate cuts before the end of this year. Mixed expectations for next year, but as we've said before, I don't put a lot of faith or stock in forward projections for like the next 12 months. Yeah, I don't buy it. We didn't buy that they were going to have six rate cuts this year. We don't buy that they're going to have X however many next year. So we'll see what the Fed does when the Fed does it, and we'll also assess, is the is the economic data supportive of continued rate cuts? So the second thing that I want to cover real quickly, or maybe more in depth, I've really spent a good deal of time thinking through this problem, which is explaining or understanding the weakness in the labor market. Um, because business uncertainty alone doesn't explain it. Doesn't explain why job additions have been falling month over month, why we've had such dramatic and skewed revisions to the actual jobs data. Um, I mean, it's not like the Bureau of Labor Statistics doesn't know what it's doing, but it the tariffs alone didn't answer the question, number one. Business uncertainty alone didn't answer the question. And even to a degree, the incorporation of artificial intelligence into businesses or enterprises didn't answer the question. So I started to go down a different path. And this is theory, thinking, BS, however you'd like to classify it, because there's no way for me to uh, find data that proves this. So walk with me into theory land for a moment, and we'll see if this makes sense. But given the very small incremental increases in inflation, the underlying reason for that to me is businesses not passing on the cost of tariffs to consumers where those tariffs are applied. And that seemed odd because that's an expense. That decreases margin, that decreases operating capital, operating cash, that decreases profits, revenue, earnings, etc. So it didn't, that alone didn't make sense to me. Um, and so I started to question whether or not businesses are trading the cost of tariffs for hiring in place of passing through the cost of tariffs to their business partners, their suppliers, their up chain suppliers, or and consumers. Are businesses not adding people capital to account for that cost? Now, it's probably not a one for one cost, but if by not adding labor, you're able to absorb 60, 70, 80% of the cost of a tariff on your products or services, then you and had originally projected adding labor, then that there's a cost balance. um this is I want to keep researching this because the it doesn't make sense to me that tariffs would not have not have instantly started to appear in the marketplace. There may be other reasons or other rationales behind this, but for the moment, this is what I have. This is what I'm working with. But as I said, there's no data that exists which would track this. The only way you'd have to literally look at every single company's reports to see what are they paying in tariffs, what did they pay previously for labor, et cetera. It'd be too complicated. So we're just going to stay at the theory level for a moment, and because this is the one thing that does make sense to me. In an uncertain marketplace, if businesses are concerned with the potential for lost revenue from sales bypassing through the tariff cost, then it would make sense to me that they would look to reduce costs elsewhere in their business. And one of the largest costs is labor, always and forever. And it's also one of the easiest to reduce by simply either reducing labor, lost jobs, um, which degree, small degree is happening, but not dramatically, or by not adding additional labor to the business. So anyway, I admit again, it's pure theory, but it's starting to make sense to me, and I wanted to bring it to you now. What does it mean? What does that really mean? Um, at some point, one of two things has to happen. Either businesses have to begin to add back labor if the economy is going to grow or for the economy to grow, or they have to begin passing through those tariffs. So because if the economy starts to pull back, right? I'm not talking recession. I just mean a general pullback, a slowdown, right? Because then that maths is not working for businesses. So those we're not there yet, but as with everything, we're always early or ahead of the curve. So we'll keep our eye on that, and if we can find more ways to get that data that can help support that, we'll get that to you. Tonight at 5 o'clock, the AI² Summit, virtual trading summit. Got it. Man, we have so much planned for folks. So I'm really excited for those of you who are taking part. I can't believe we have a little over 100 or 102 people registered for the summit tonight. So if you're attending, thank you. Looking forward to seeing you. Really, tonight's going to be big. I have so much planned for you. So if you're attending, make sure you grab a big screen TV because it will be worth it. It will be better than anything that's on TV tonight, except the Detroit Lions Baltimore Ravens football game, I hope. Weekly performance with a bad slide there. Sorry about that one. These were 6 stocks that I talked about in last week's webinars, in different variables here. So 3 stocks that had been the previous top weekly performers, and then 3 stocks that merited your attention as an investor or trader. So I'm just keeping track for right now from last week from the previous week to the next week, and look at some of the returns here in one week. Veritone, VERI, was up 46%. That included a 28% rise in the price of the stock on Friday alone. So huge move for Veritone last week. Amprius, now that I have the right stock symbol, AMPX, Amprius up nearly 40% on the week. And I detailed the technical chart on that, a very long consolidation period at the $4 level, followed by a secondary consolidation period at the $8 level. And the thing that's about these two companies, both of them are, Amprius was trading around $11. Veritone was trading around $5.60. So you would normally think it would be reasonable to think that these are as small cap stocks that they don't really have a whole lot of volume. And then you would be very surprised to discover that Veritone is trading an average of nearly 4 million shares a day, and Amprius is trading an average of nearly 18 million shares a day. There is some heavy volume taking place in companies in this AI2 space. And that's a good thing. That volume can translate into massive rises in the stock price, as evidenced by last week, um, and sustained moves higher. So, two big moves for two of the stocks that I talked about last week during the week. IonQ and Innodata both extended their rallies up 5 and 16%. Coherent and Credo were two of the stocks that I highlighted as long-term stocks that you could conceivably hold. Smaller gains, 2%, 3% for the week, but that's fine, right? They were positive. That's good. So really excited about where things are headed and looking forward to seeing everybody in tonight's virtual trading summit. With that, Jeff, I know you have a good deal to share, so let me stop here and let me know you have PowerPoint working and you're ready to go.
Yeah, I am good to go.
Off you, it is all yours.
All right, here we go. Hello, everybody. Good morning. Let's just see PowerPoint. Hopefully this works. Can you see?
Yep,
Okay,
you're good.
so awesome. All right, so economic calendar this week, a little bit heavier than what we've seen in the past. We have flash PMIs early in the week, core PCE on Friday. And both of those are, key to market direction. I guess it depends on what you believe in. I know in some of these trading programs that we have, like Millionaires Trader Club, we don't really pay attention to the news that much because if you look at every report, there's going to be a report every day, every week, whatever, that would prevent you from trading. So, but it is important to know, especially if you're trading zero DTEs, you want to make a note of the times of when some of these are taking place. Just so you understand the volatility of what's going on. But now with last week with triple witching, which was the expiration of multiple options contracts, we are looking at flows resetting this week, and so that can create some volatility. A lot of people in research has gone into triple witching, whatever. I've actually seen a little bit more volatility the week afterwards, which doesn't necessarily mean anything bad. That just means that some of this data may start influencing the move of the market for that particular day. But if, for example, flash PMI comes in tomorrow or whatever, a little bit lower than expected, we might get a little bit of a sell-off, which increases volatility. But as things are resetting, that's actually a really good time to potentially buy for, the next 1, 2, 4 or 5 days, So look at short-term volatility as a good thing, but I wouldn't be surprised to see quite a bit of volatility increase this week from previous weeks. As far as some big news, today is the day. Robinhood, AppLovin, and MCore should all be appearing in the S&P 500 officially. So it's not guaranteed, but we talked about this a couple weeks ago. Oftentimes, prices continue to move higher after initially being added to an index, purely because you have a lot of funds that need to be acquiring shares and balancing out their books. So watch out for those. The opposite is also true. You can do some searches online, but Robinhood is replacing something, right? It's right around 500 stocks in the S&P 500. So if Robinhood is set to gain because of being added to the S&P 500, then the stock that it is replacing is probably going to start losing some, as some of these big funds have to sell out of those shares. So anyway, those are 3 sort of quick ideas for you this week. As far as the overall market goes, I've answered quite a bit of questions about, hey, this is, market's been up for so long. When is when's it all going to fall apart? Whatever. Usually the questions kind of come in when we're trading at all-time highs. People, for whatever reason, don't like trading at all-time highs, even though it was trading at all-time high here, kept going up, traded at all-time high here, kept going up, traded at all-time highs here, went up here, whatever. So at some point, of course, yes, we will have a dip. I don't know if that's going to be today. I don't know if it's going to be next week or whatever. But what I would look at is in this particular chart, if you go back to the April lows, so far we've had this minus 3.5% dip, a minus 2% dip, a minus 3.5% dip in 2 days. Minus 2% dip, minus 2.5% dip, all that. So, and if you notice that the 24 period exponential moving average, that's this lower one, has been holding up as support. So right now we're a little extended from that 24 period moving average, which is way down here. But I would look at if we are going to have a pullback, I would expect one to be in that sort of 2 to maybe 3.5% range. And I would look for a 24 period exponential moving average to be a line of support. Now, yes, this one did break through the 24 period moving average, but it immediately bounced higher. So there was no confirmation of that. All the other times it got close. And even on this bar here, it went below, but it couldn't even finish below. It finished the day almost at the day's highs. So if you're a little bit worried about the market, what I would say is look for a 24 period moving average, exponential moving average. Look for, or if you want to expect a slight 2 to 3% little dip. And right now, I would say that would be a good time to buy the dip because we have no other indication that things are going to start falling apart from there. So I think this is actually not a bad thing, and I would keep with the overall trend being going higher. As far as seasonality goes, the exciting part of seasonality is we are through those sort of 2 bad months. We've talked about August, talked about being a little bit cautious in August and September. As far as seasonality goes now, the last 2 years, October has been down, but overall for the last 15 years or so, we start seeing some bullish moves in stocks right around the week of September 22nd. So hey, that's this week. So even if the rest of the market or the S&P 500 is down in October the last 2 years, that doesn't mean that there's you still can't find some really good stocks with some strong seasonality going into the rest of the year. And actually that brings me up to this fourth quarter discussion, which is this is kind of the most exciting part of the market. So as we get through September, October actually has an average of gain of 2.26% leading into November, which is an average gain of 3.28%. But looking at the percent positive, this is going all the way back to 2010. I know it's a little hard to read. We can zoom in. So 2010 to 2025, plenty of years of data, 60% positive in October, 80% positive in November, 66% positive in December. So this is a very exciting part of the year. Yes, I just talked about this in 2024. October was, essentially down a little bit. In 2023, October was down a little bit. But you see some other really nice gains in October. So it's something to keep looking at and finding those strong stocks in strong sectors, maybe those AI sectors that John's talking about. You might want to attend tonight to figure out what those are. But definitely an exciting part of the market coming up here. As far as, did I skip ahead? Nope. Okay. As far as market performance, the other thing that we look at is how many stocks above their 20-day moving average. And the nice thing about this is we aren't really overbought on any of these categories. Information technology, circled at yellow because it's a little hot at 72%, trading above their 20-day moving average. Consumer staples, 19, I would say normally, that would be that oversold category, but I circled that in yellow only because consumer staples tends to be a little bit more defensive in nature and doesn't always follow the same rules that some of the other sectors do. So if we start seeing defensives like consumer staples take off, or we start seeing some of the economic news this week being a little weak, then I would say consumer staples oversold, and that's a good sector to look at for the week. Otherwise, the nice thing about this is there's still plenty of room on all of these sectors, including the S&P 500. Only 46% of the stocks trading above the 20-day moving average. So we are not in an overbought, we are not in an oversold area whatsoever. So that, I'm not saying that that means the market is going to automatically go up this week. I'm just saying that there is still plenty of room in some of these stocks for the market to keep going up this week. Now, as far as some other just ideas for the week, we have energy. Energy does seasonally have a seasonal pattern going into the end of the year. So a ETF like XLE, we are rounding out at the $88 level. We've seen $88 level act as an area of support before. It was an area of congestion back in August as well. We did break through a little bit in September, but again, the seasonal pattern that sort of what we're looking for does start moving higher from here. Now, whether it does that this year, I don't know, but XLE around that $88 level wasn't really providing a whole lot as far as selling options go. There was no, put credit spread. There was no cash secured put that really gave me a lot of value. But if you like energy into the rest of the year, then you might look at something like Diamondback Energy. Diamondback Energy is in a little bit of a lower trading channel right now. This green line is the current stock price. And so, yes, we have lower highs, sort of lower lows or flattening lower lows. So we're in definitely a little bit of a channel. But if you actually look down here, this red line is its seasonal pattern over the last 10 years. And you can see that we have a peak. Now this peak happened a little earlier than its normal peak. We have a peak followed by a lower peak. Well, we had a lower peak followed by a lower peak. And we had a third lower peak. So this has actually followed its seasonal pattern quite well. And you can see by the end of September, this is where Diamondback Energy, ticker symbol FANG, which is in the XLE ETF. This is where this gets really exciting for FANG. Now, will it happen this year? I don't know. But if you are willing to take a shot on this one, you can buy a 17 October 140 by 145 call. That is a long debit spread. It's only going to cost you $240 per spread, but it's a 5-wide spread. So that means if it expires above $145 at expiration in 17-ish, 20 some days, if it trades above 145, that means you get to capture the full $5 value. You paid $2.40, so that means you can actually double your money on this one. You would collect $260 in profit on a $240 investment. So that may be worth your consideration. That's just a long call. You can look at it a bunch of different ways, whether you want to do put spreads or whatever else. Not a recommendation, just an idea for you, just because I like giving out free trade ideas on Mondays. As far as market sectors go, the last 5 days, nice up 1%. You can see communication services kind of took off here. Again, consumer staples, those defensive ones, fell off minus 1.3%. So right now, across the board, sectors seeming to enjoy the rate cut that happened last week, and now we'll just see how everything kind of reevaluates for the rest of the week after the triple witching that we had last week. As far as the equal weighted index, EUSA, we've been looking at this one for a couple of weeks now. And this one, this is the Heikin-Ashi candles. So Heikin-Ashi candles help us smooth out the trend a little bit. And you can see long-term trend has been up. We are continuing that pattern. We are in a series of green Heikin-Ashi candles. We do have some lower wicks. That's not really what we want to see. If you go back to these green candles, we had no lower wicks. So lower wicks kind of came in with this indecision. So we'd like to see, some of these lower wicks kind of go away and then continue up. Right now, just sort of based on a very recent fib pattern, I would say we're projecting about 103.38 up to 104.33. A little aggressive side profit target on the EUSA. So as long as we stay with green Heikin-Ashi candles, as long as we continue up on this trend, I'd say 103.38, 104.33 would be my sort of next profit targets on that. Yes, that would actually make a new all-time high, or at least a new yearly high on the EUSA. So things are moving along there. And then the last free trade, we're just giving away stuff today. John's going to get me into all sorts of trouble for giving away too many free things today. But here's another one, HPQ. Not exactly, not exactly what it once was in the early 2000s, but this is HP computers. They're into a lot more than just computing now, into server spaces and everything else. But 9 out of the last 10 years traded higher from 922 through 1113. The median gain was about 5%. And so that, and also I just kind of did a fib projection level based on going from the recent low, recent swing high, and then recent low. And wouldn't you know, the fib level, that first 38% projection fib level is 2966. And look at that, 2960 would be about a 5% gain from where we are. So I think that HPQ, if this continues to round out, we had a little bit of pullback. We're on green Heikin-Ashi candles. I think we can easily make it up to 2960, 2960, 2966 by 1113. Now, I know I tried to do an option play. I tried to even buy long call. I tried to do credit spreads. There was nothing really that I liked. We'll see when the market opens if that changes. But right now, for 27 bucks, to me, this is just a pure stock trade. So if I know, not a lot of traders reserve like buying stocks, but we're going to make you stock buyer
Oh, yes,
believers
they do.
here.
Oh, yes,
Yeah,
they do. And after tonight, they're all
I
going to
was
want to be
I was
buying
gonna say
stocks. I can
we're
promise you
gonna
that.
we are gonna make you all stock believers here in a little bit. But
All
anyway,
right, that's it from Jeff, and that wrap up Breakfast Club for today. Again, we'll be with everyone in the AI Virtual Trading Summit, AI2 Virtual Trading Summit tonight. You should expect, as I walk through the index, the building of the index, we have over 20 stocks that we will share with you that are part of that index. We're also giving away 3 long-term stocks, 3 small cap stocks, little 10 stock trading portfolio. So there's a ton that's coming in. Then tomorrow is all the options trades. So 2-hour a night summit. Really excited. Looking forward to seeing everyone. And we will be back with Breakfast Club at 8:30 on Wednesday morning, and we'll catch up on economic data and any other news or interesting items that we want to pass along to you then. So everybody have a great week. We'll see you in Millionaires Trading Club at 11 a.m., Income Masters at 12:30 p.m., and then the AI2 Virtual Trading Summit today at 5 p.m. Eastern Time. Make sure you have your Zoom registration if you're attending. If not, just email into support and I'll make sure to get you set up for that. Thanks, everyone. We'll see you in a trading session or the summit, and have a great week this week.